As we talk about maybe what to get into here, Michael, if this is the bottom. But first, I want to hear the case for the bottom. Michael's a principal and CEO at TrueMark Investments and TrueShare. So walk me through it. Why the bottom? What makes you convinced?
Well, I'm not convinced, but I think we have seen it, Oliver. It's, last week we saw a lot of momentum into the close. We saw a lot of short cover. I think there have been some signs since we'll call the shock and awe stimulus packages have hit the street that we're seeing a little bit less volatility. I think we've got good news on the horizon with, as your last guest mentioned, the potential of negotiations between all the big oil producers, between Saudi, between Russia, and certainly the U.S. has a voice in that. So I think there's a lot of momentum there, and from a market standpoint, I do believe we saw the bottom somewhere back around S&P 2200. But really, it's all about the virus now, and I think the underpinnings of the economy are being managed quite well. But the virus is the story of the day for me, and certainly, whether or not we see progress in treatments for that virus, if we see a flattening of the curve, if we see any kind of change in our projections on that, that could rattle things a bit more. But I do think the bottom was last week.
That's where it gets tough for a lot of investors, Michael, because they say as much as they feel comfortable analyzing stocks or asset classes, they have no idea how to analyze a virus. What to you are the most important metrics then for determining the market's behavior? Is it just total case count here in the U.S.? Is it reinfection in areas that have been reopened in China? Is it a big breakthrough that says, we can't find out a vaccine, there's something unique about this, it mutates so fast? I mean, what's kind of then on your radar for news catalyst?
Well, I think it's two things. I think one, obviously, a breakthrough on the medical front would be very welcome. I think you'd see extreme, optimism following that. But again, I think you have to see a flattening of the case count. I think we know that the next couple of weeks we'll continue to see a rise in confirmed cases. I think if you look at the U.S. mortality rate versus the global mortality rate, we're in a bit better position there, but we're not sure we've seen the worst of it here yet. So as the testing starts to spike, as we see the much better data come through on confirmed cases and a much better handle on how widespread this actually is, I think we'll start to see the depth of the problem. I do believe that, from all I've heard, that the virus, once we get our hands around this thing, in a couple of years, it will still be around, but it won't be as damaging as it is now. So realistically, if you have a twin shock to supply and demand like we have had worldwide, you're going to see some issues in the marketplace. But as long as those supply lines start to come back online, and certainly you see case counts flatten out or roll over the top, both globally and or domestically, then I think we have a pretty good idea that we'll understand what we're dealing with. And I think the uncertainty more than anything is what's giving people fits.
Yeah, I think it's well said, Michael. In the meantime, where do you put the money? Do you want to bet on this? Are you willing to do it? Are you in your strategies right now adding on equities? And what kind of equities?
Absolutely. Yeah, we're risk on here. We're adding equities. I think that we've got a couple of different portfolios that benefit from this, and certainly our tech, AI, and deep learning portfolio has some of that technology, the work from home trade, as you accurately put it, involved in its portfolio. I think work from home or work remotely has been around, but it's going to expand. I don't think it goes away. I think we'll see some evidence of the effectiveness of it as we move into Q3 and Q4 and see what's happened to earnings. But particularly with tech companies, I think the work from home trade is real, and there are ancillary trades that go along with that. So when you have different functions like Zoom or Microsoft Teams, or certainly from a business sense, cybersecurity becomes an even bigger issue at that point. And so you have ancillary trades to build off of that. Some of the core movers will be there, the Microsofts and Amazon for obvious reasons. But then we have cybersecurity companies like CrowdStrike, that employs significant AI in helping to guard those cyber lines. And in the healthcare arena, you're seeing incredible amounts of funding and resources devoted to ramping up the speed at which we discover drugs. And certainly that's a very sensitive situation right now with COVID-19. So I think you have some names like Schrodinger and certainly Guidant over on the healthcare side that employ significant AI technology to speed up that drug discovery process. In our ESG portfolios, I think there are quite a large benefit to those companies, considering what's happening with the reduction in commuting, the reduction in energy spent, on large brick and mortar operations at the moment. And certainly, I think we'll start to see some side effects there. We've got companies like Citrix or Prologis, which is a great warehouse REIT. Even companies like MSCI will see a benefit from this because there's so much dislocation with capital markets, and certainly there's a massive ETF universe that pegs itself to MSCI in some way, shape, or form. So I think there are a lot of trades to be made in the work at home capacity.
Michael, really interesting stock picks here. I gotta say, it's not often I see a stock I haven't heard of, and Schrodinger is one of them. So I'll put that on my radar to watch. Really interesting connection both to tech and biology right now. I want to talk about another point that's a little bit more macro here, and we'll keep looking at some of the names that you mentioned. I appreciate the insight on what you guys are buying right now. One of them, though, is that you're going to be more, you think you'll be more concerned about inflation than economic expansion by mid-2021. I think this is a crucial point to address. It's one we've kept our pulse on, even though right now the immediate concern is one of economic collapse. Is it your view then that analysts and strategists, economists, et cetera, are overestimating the lasting impact of the prints that we've been seeing from employment right now?
I don't know if that's necessarily the case. I think it was necessary, to digest this, obviously, but there was a need for shock and awe with this, and I think we learned a significant lesson in 2008. The economy, the fundamentals of the economy going into this crisis, I think were fairly healthy, and so there's no reason to expect that they'll completely erode over the course of the crisis. Now, if this extends out into late summer, we've got problems, but certainly I think the optimists amongst us will say that's likely not going to happen, at least in the capacity we see it happening right now. But when we do get to the other side of this, the shock and awe stimulus packages, which I believe were necessary, will take root. And when that takes root, there will be an incredible flood of capital in the market. And certainly I think there'll be a ton of pent-up demand in that system as well. So it was a necessary move, but in the end, it's going to be a very delicate process to manage mid next year into late next year and manage the retracement of all of that credit.
Okay. Michael, really good conversation. Let's keep it going. I want to follow up on these names as we see the situation unfold. Really like the take here. Always good to hear a little bit of a different side than folks that are just waiting and watching. Mike's making moves and buying stocks here, looking at potential bottoming here for the S&P 500.